Hey everybody, this is Ryan Mallory, and we're going to do a stock market update for you here. The S&P 500 down 3 straight weeks. The Nasdaq down 3 straight weeks. The Russell down 3 out of the last 5 straight weeks, but actually up this past week. What does this all mean for the stock market? Are we going to see another crash like what we saw in February, or are we getting ready to bounce? We're going to cover that and more in this stock market update video here. We have the S&P 500 7.9% off of its all-time highs. We have the Nasdaq down 10.6%. And you want to know what's dragging those indices down? Apple. That's right, Apple is down 22% off of its all-time highs. You have a $2 trillion company that starts to pull back some, it's going to take everything with it. Now, what did not pull back as much? The Russell. The Russell is only down 4% off of its most recent highs. Now, between those three indices, it's the Russell that has not reached new all-time highs yet. So we're going off of the most recent highs. It's pulled back 4%. But the reason why it hasn't pulled back like the rest of the market is because it doesn't have Facebook, Amazon, Apple, Netflix, Google, or Alphabet, Microsoft, or Tesla in the Russell index. As a result, the FANG's influence on the Russell is going to be far, far less. And that is why you're seeing the money flow into the Russell and out of the Nasdaq. And the S&P 500 is like a bystander that's just going to be penalized because it also has all the FANG stocks in it, but not as highly concentrated as like what you see in the Nasdaq 100 or the Nasdaq Composite. So I'm going to cover the Russell index, the Nasdaq, and I'm going to cover the S&P 500 on both the daily, weekly, and monthly charts for each of them. We saw some key support levels get broken this week, but we've also seen some support levels not get broken yet. We're in oversold conditions, and we could see a potential market bounce this upcoming week. Or if these support levels don't hold or we don't recover some of these broken ones, we're going to see much more to the downside. So let's go ahead and jump into the technical analysis right now. Now, even though I said that the Russell was doing the best over the past 3 weeks, it's actually the one index I don't want anything to do with because the reward isn't there. Now, why do I say that? It's because you have this huge chop zone going back to 2019, 2018 even, and it can't break through that choppy range. And it's right in the middle of it right now. And until it can break out of that choppy range, I want nothing to do with it because it doesn't give you a good reward. It gives you a decent risk, but the reward is not there because it's very much capped by overhead resistance. You have two major resistance levels that I'm the most concerned with. The first is the one coming off of the 2020 highs, so that even if the Russell starts to move next week, it has a huge resistance level right there that it has to contend with. But not only that, you have a resistance level going all the way back to 2018 that it has yet to break through. So you have two resistance levels that are in literally like the same place that's going to create havoc for the Russell going forward. So I really don't want anything to do with the small caps. Even if we rally next week, it needs to break through these resistance levels before I get interested in it. But the good part is you actually have a bull flag that's forming on the weekly chart. And if it can break out of this bull flag and through that resistance, you have a nice breakout play that should see a retest of the 2020 highs, if not the 2018 highs. Now, what about the monthly chart? Not really that great. So while the weekly looks good, the monthly does not. You have the declining trend line off of the 2018 highs that could cause some problems here, even if we do break out of that bull flag on the weekly chart. Plus, you have the rising trend line off of the 2009 lows, and while it's not a perfect trend line, you kind of get the sense of where this trend line is at and what it needs to hold. If we come back down to that level, that trend line is still very much in effect. And speaking of imperfection, the double top that's there on the monthly, it's not a perfect double top, but it's definitely a double top pattern there. The right top is a little bit lower than the left top. However, the retest back into this choppy range that we saw back in 2019 that shows up even on the monthly chart is one to be respected. Because right now, the Russell, even though it's holding up pretty good over the last few weeks, it looks like a dead cat bounce over the last 6 months. Hey, and before I forget, make sure that you check out my new feature. It's a YouTube channel membership. It's been going for about a month now. It's really solid. It's really exciting, and it provides you with a lot more additional information beyond the 2 videos that I do every week. These videos will not change. They'll still be coming at you twice a week. However, this takes you beyond the videos and gives you access to my market updates twice a week. It gives you updates to my indicators. It gives you updates to all the FANG stocks plus Microsoft plus Tesla, and you're going to get access to my updated watch lists throughout the week, and you're going to get the charts that I find each and every day that I think you should be watching. Now, the Nasdaq is interesting because we have this head and shoulders pattern there that not a lot of people are talking about. So is it coming into play yet? Not yet. It's not confirmed. It hasn't broken this neckline. You have the left shoulder, you have the head, and you have a right shoulder. It's actually a pretty nice looking bearish pattern, topping pattern, but it's pretty solid. It's broken below the 50-day moving average, which, to remind you, hasn't done that since April, but it has not yet broken this neckline. So the reason why that's important is we've seen a lot of head and shoulders patterns over the years going back to 2009. They'll form, I've seen them on the indices as well, whether it's the S&P 500, the Nasdaq, or the Russell. They'll form, they'll look like everything's about to confirm. It'll break the neckline for just a little bit, and then it'll go right back up to all-time highs again. And that's the big bear trap that could loom out there, because we're now oversold on the stochastics on a number of other indicators. So we could see an oversold bounce here off of support, because right now that neckline is still acting as support for the bulls. They haven't broken it yet on a closing basis, and as a result, you have to believe that there's going to be an attempt at the very least to bounce this thing off of the neckline and not confirm that head and shoulders pattern. But crazy things happen, just like what we saw back in February and March, where bearish patterns do confirm, and it leads to much greater downside. So if that does not hold and we break to the downside, I would look for this next support level here going back to the February highs to be what holds next. It's a nice support level. It's around 10,330. If that can hold, then you might see your next attempt to bounce the market higher. Now, I'm not trying to get uber bearish on you guys, but things tend to happen that can take us by surprise. So if all these support levels start to fail and we do see a big pullback, and remember, we're in a major pandemic, we're in a major recession, capitalism has essentially shut down, starting to reopen, but there's a lot of people dragging their feet still. You have high unemployment, bad GDP, a lot can happen here. So watch this rising trend line off of the 2009 lows where the whole Great Recession bottomed out at, because this could end up being in play over the months to come. And if that happens, this could be an incredible opportunity to get long on the market. Now, you're going to say, hey, Ryan, there's no way that we go back down to this level. And that's wrong. In 2000 and over the years that followed, we dropped 87% on the Nasdaq off of its all-time highs. It is very possible, especially with the Nasdaq. So when you start seeing us get this disattached from its long-term trend line, the potential for a major pullback does happen. You're already seeing it on more of a micro level with Apple and how disattached it got. It's pulling back to its rising trend line now. And if Apple can drop 22% in a month, anything can happen. Again, looking at the rising trend line on the monthly chart, it becomes even more clear. It's very solid, it's very strong, and over time, these trend lines do get retested. So don't be surprised over the course of many months to come, we don't see a pullback down to this level again. And right now, the Nasdaq is working on a bearish engulfing candle pattern for the month of September. The reason why that's not good is it's already wiped out pretty much all of August's gains, and August's gains were amazing for the Nasdaq, but right now it's all gone. And when you get these bearish engulfing candle patterns, they oftentimes represent a top in the market. When they open higher than the previous candle and close below the previous candle, that's where you want to acknowledge, here's a big warning sign, I need to be careful here. Now, as for S&P 500, and we're going to use SPY in this example, I would be nervous here because it did break the neckline of the head and shoulders pattern. But as we have seen a lot of times before, and as I mentioned with the Nasdaq composite, oftentimes these head and shoulders patterns are bear traps. So it'll suck the bears in short and then it'll pop right back up. Not saying that you can't short it here, but be careful as you do. You want to make sure that you're following your stop losses, because if it is a bear trap, you want to go ahead and get out of it. And we saw some buying into the close that could lead us to a bounce next week. And if that's the case, you want to make sure that you just don't ride this short position all the way back up to all-time highs, because right now there is a breakdown starting to occur on the S&P 500. However, it needs to follow through to the downside to confirm. I also mentioned last week that SPY needs to recapture the rising trend line going all the way back to April. It did so early on, but quickly gave up those gains in the latter part of the trading week. Should we see additional downside, there's a lot of gaps to still be filled. 3 in particular. One going back to the March lows. You also have another one in April, and you have another one in May. All of these have been left unfilled. All the ones since then have done a pretty good job of getting filled. But those 3 gaps below have not been filled, and the reason why that's important is most of the time, markets do not like gaps in their charts. If it sees a gap, it'll come back down and fill that gap with a price candle. I also think it's interesting, I didn't even notice it until I was doing this video. Look at the weekly chart here on SPY. It's almost like we're in this expanding megaphone here where the price action just continues to get choppier and choppier over the last 3 years. If you go all the way back to the beginning of 2018, it's almost like we're range bound, but the range is getting bigger and bigger and bigger, and it's creating more and more chop. Now you have some support underneath if this market does continue to break down, where there's price level support going back to late 2018 that cuts across. We broke back above it in late 2019, but then we had the big massive sell-off in February. Now we're right back above it, very similar breakout. Are we just going to pull right back down again and even go lower than the March lows and test that declining trend line underneath? On the monthly, like the Nasdaq, you have the potential for a bearish engulfing candle pattern here. It's almost wiped out all of the August gains. Not as bad as what we've seen on the Nasdaq, but it's getting very, very close. And if we've learned anything from the SPY over the years, it does gravitate to that 50-day moving average and likes to test it after each major rally. So after 5 months of constant rallying, we may see another pullback down to this 50-day moving average. If it can hold, that might be a good area as well to get long on some key names. The interesting thing about it all is that the market's going to live and die by the FANG stocks. They've gotten way too big relative to all the other stocks in the market. Apple itself is pretty much as big as the entire Russell 2000 index. As a result, you take Apple and you connect it with the rest of the FANG stocks, you're talking about $7 trillion at least of market capital tied to about 6 stocks. And that's getting out of control. So when they start to pull back, it's going to weigh on the entire market. And if you start seeing the FANG stocks pull back, probably the safest place is going to be the Russell index. Can't guarantee it, but that's a good place. And despite the Nasdaq being down 10%, almost 11%, despite Apple being down 22%, you haven't really seen a big move in the VIX yet. In fact, it's relatively compressed. You saw an initial move, but then it's come right back down, as we've seen it happen so many times before since the March bottom. And so if this market's going to really start pushing lower, this VIX is going to have to wake up some and start pushing higher. So there's a kind of a disconnection here in the stock market. You have the VIX that's kind of staying down, but you have started to see the weakness in the FANG stocks, where stocks like Apple are pulling back 22%, and you're starting to see the Nasdaq lead the way lower. But you haven't really seen a true breakdown yet. We're sitting on some key support levels in some indices, while others are starting to show the breakdowns are already starting to happen. We're extremely oversold, and so the potential does set up next week for a dead cat bounce, if nothing else. But still, there's a lack of conviction by the bears to really drive this market down lower, like what we saw in the earlier part of this year, also like what we saw in the late part of 2018. You're just not seeing that huge momentum shift to the downside. And now we're sitting at oversold levels that could easily stick us into a place where we're going to see a big bounce higher here. And all in the coming week, you need to be prepared for anything. I can see where this market goes much lower, and I can see where it recovers and goes much higher. I'm neutral in my own portfolio right now. I'm not sure where it's going to take us, but I wanted to lay out all the scenarios for you, as I did in this video here, to give you an understanding of where the possibilities are. If you like this video, I'd encourage you to like and subscribe. It helps me to continue to expand my channel and to reach more and more people. Thank you so much for listening each and every time I post one of these videos. If you have any questions, feel free to throw them down in the comment box. I try to get to almost every one of your comments. I really do. Every day I spend time going through the comments. I see them. I appreciate them. Well, most of them. And I encourage you to leave them down below. Let me know, what is your plans for the coming week? Are you still long? Have you started to get short? I want to hear about it. Thank you, and God bless.